If you're like most mortgage lenders and loan officers, you're mulling over, am I doing the right thing? Am I following the right strategy in this market transition that we're in the middle of? Obviously, interest rates are going up, housing inventories are starting to cool down, and we're looking for any bit of trend line or confidence builder that we're just headed in the right path. And in some of our cases, we might even be concerned about just basic survival. Hi, my name is Bill Rice. I'm the CEO of Kaleidico. We're a lead generation agency specifically helping mortgage lenders do consumer direct transitions and helping lenders transition through this market change. We've been doing this for 20 plus years. We've seen several of these transitions. And although I'm not one to follow the leader or advocate those kind of strategies, I think when we are moving through market transitions, it's really important that we take a look at some of the leaders and some of the proven entities who have moved through these transitions. And these can be strategists, advisors, but most importantly, I think taking a look at lenders who have shown some consistent ability to move through these kind of transitions in a good way is not a bad set of analysis to do. So I did just that. I mean, one of the things that if you've been in the mortgage industry for any length of time, you know one of the names that you will hear over and over is Rocket Mortgage, formerly rebranded from Quicken Loans, right? So to do this little exercise and to give some reassurance to some of our clients that some of the advice that we're given, the recommendations that we're giving, are founded in some best practices that again, some of these leaders like Rocket Mortgage who have been through transitions like this, they went through the mortgage meltdown, they went through the financial collapse, and actually accelerated market share, right? They went from, I don't know exactly the number, I think it was like 10 or 11 at the time, to unquestionably number one today. And they did most of that by making the right moves during that downturn, right? So in order to do this exercise, I just simply went to the Q2 earnings call, pulled up the transcript. The nice thing is now they're publicly traded, so a little bit of the mystery and the shroud has kind of been removed as to what they're doing. And they're essentially not only disclosing some of the bigger strategies that they're following to move through this transition, but they're also essentially pitching investors to say, hey, here are the things that we're doing that should give you confidence that we're positioning correctly for this transition, not only to just survive, but as Jay Farner says in this note, in this earnings call, to actually take market share, which again, remember, if you go back and look at history, the last time we went through a pretty dramatic transition in the market, they took substantial market share. So he's speaking from experience, not only organizationally, but as an individual leader inside of this organization, because he was there. Most of their leadership is in their 20 plus years, so they've been through these cycles. Anyway, long story short, I took this earnings call and I wanted to break down and pull out some of the bigger strategic points that they mentioned in there. And I wanted to try to reposition those a little bit or tweak them such that they're strategies that you can look at following. Again, not to follow the leader, but to right size for your particular position in the market and give you some confidence that there is an ability to not just survive, but actually gain market share if you make some of the right moves. So let's take a look at four major strategies that Jay Farner and Julie Booth inside this earning call, their CEO and CFO, highlighted as the major strategies that they're pursuing and four strategies that I think you can easily implement in your own transition strategy, right? So as we move through this transition in the market, first and foremost, one of the headlines that you will see over and over again is such and such mortgage company lays off thousands of people, right? And one of the interesting notes inside of here, and Quicken Loans, depending on how well or how familiar you are with Quicken Loans, I'm going to keep saying that because that's so etched in my mind. Rocket Mortgage, you don't know a lot about it. They have since sort of moved into a family of companies that they've been building over the last couple of decades. So they have some flexibility, some tools that maybe the average monoline mortgage lender doesn't have, but you can still use some of these tactics. So in particular, in talking about laying off people, they did something a little bit different. They took about 2,000 or so employees, and they took some optional buyouts, gave people options to leave and be purchased out, and so sort of voluntary. But most of what they talk about is 2,000 or so employees that they redeployed. And I think this is a really critical strategy. One of the things, and I've been in the mortgage industry 20 plus years myself, one of the things that I always see anytime the mortgage industry hits a little bit of a hiccup, the first thing that always seems to happen is we just instantly lop off a significant percentage of particularly our loan officers, our sales, which always seems a little bit counterintuitive to me. But we lop off hundreds, thousands of people instantly because as we look at, our P&L, one of the largest expense items is always human resources, right? It's always the people. And so you can get a big chunk of expense pulled out of that equation really fast, but just simply laying a bunch of people off. But what I think is really brilliant in here is what Quicken Loans has done is redeployed those people. So it's looked strategically at what it's doing, and in this case, in the full family of companies, but even in a smaller organization, look at what you're doing and say, is there a way that I can redeploy these people? They could be loan officers, they could be salespeople, they could be marketing people, which are often the first to go. Again, counterintuitive, right? You need that lead flow, but you're taking out the two major influencers or impact on that lead flow. But redeploying, maybe you could take some of your top salespeople or even your midline salespeople and say, hey, instead of being on the front line doing deals and holding a quota, maybe we want to take a couple months and we want you to dive into the sales operation and figure out how we can make this more efficient, how we can optimize this, how we can get more out of what we're doing by leveraging technology, by leveraging and improving our processes and systems. I know when I was at Quicken Loans many, many years ago, Dan Gilbert instituted the Mousetrap program, which was absolutely that. We were diving in and we were figuring out how to make the whole process end-to-end more efficient. So the neat thing about that particular strategy is not only are you redeploying, which is great for your workforce, it's also not putting you through the pain of cutting off a bunch of people that spend a lot of money and a lot of effort in order to recruit some top talent. By redeploying them in and giving them the challenge, the responsibility to find ways to cut expenses in the operation, you can potentially get a twofold effect, right? You're pulling your expenses down. And again, this is some of the things that are disclosed in this earnings call. You're pulling some of those expenses down by taking those people that you didn't lay off that are really smart and can figure out and understand operations better than anybody else because they've been doing it. They can dig in there and they can look for opportunities and claw back some of those expenses without having to lay off the head count. So that's a great thing. The other thing that's really important here, I wrote a previous note, you can take a look into my archives, but one thing that's important as we go through a recession, the average historical recession only lasts about 6 months. And this is highlighted in here as well, because Jay Farner basically makes a statement that it doesn't make any sense to lay off all these people, go through that pain, that effort, and to some degree that expense, when in 4 to 5 months, you're going to need those people desperately, right? So they're leveraging those people to get and claw back some of those expenses, making them accountable for it, using them in a better position to make them more efficient, and sort of holding them in reserve and holding a little bit of capacity in reserve in order that 4 to 5 months, at the beginning of 2023, when they think that they'll be in a growth mode again, they won't have to go rehire all these people. So I think that's first a remarkable sort of thing to think about. Instead of going quickly to the knife to lay people off, think about how can I redeploy that talent in a better way. The next thing, the second sort of strategy there is to position yourself into innovative lending products and growing consumer and wherever there is consumer and market demand, right? So things are going to shift. There is still going to be lending, and depending on where you are in the market, you don't have to sort of stretch as far, right? Because you just need a smaller piece of that market share. So look for innovative products. If you're using wholesalers, they're coming out with all kinds of more innovative, clever products, bank statement loans, DSCR loans, which are helping the still strong investors to continue to borrow and lend against their investment portfolios as they're continuing to acquire and fix and flip things, property managers, gobbling stuff up for strategic reasons. So look for those more innovative products. One example of this from that Rocket call is, of course, they're thinking about home equity. Lots of people are. So accelerate, get into that market quicker. Lines of credit are certainly interesting. The traditional loans, there are some interesting things around sort of these hybrid products where there's some buyback. It's basically sort of you buy the rate down for a period of time. It's kind of a hybrid arm buy down sort of thing. But there's all kinds of, like I said, innovative products in areas where there's still demand for, and there's still strength in the borrower. So take a look at that. Second strategy that they mentioned in here is solar. And so essentially what they've done, and through acquisitions, but you can certainly do this with partnership, they've got a solar company, and very clearly there's a lending component to that. So looking for opportunities where there's still lending going on and figuring out how you as a mortgage lender can position yourself alongside that demand as it changes and reshapes. The third one is investing in technology, consumer direct. Your engagement platform is what Rocket calls there. There are many names, but first and foremost, they're online, and they are increasingly, overwhelmingly, almost 100% mobile, right? We're seeing across the board in all of our clients, all the leads that we're generating, easily 75% of the leads that we're generating were actually generated, the user was on their mobile phone, which is just staggering. We're not talking about traffic here. We're talking of all the leads that we generated, 75% of those leads were actually on their mobile phone when they filled out the form. So that's something really important to think about is, are you investing in that mobile technology? Are you investing in consumer direct? One of the big fallacies that I keep hearing in the market from some really experienced people is that consumer direct is only a refi channel and therefore they're getting out of consumer direct. Well, let me tell you, since 1998, Quicken Loans at that time and Rocket Mortgage have continually invested online 100%, right? They shut down their branches and the retail operation years and years ago, decades ago, and they are only doing consumer direct. So if you're waiting for that kind of traditional model where that real estate agent's going to hand you a referral, give it up, because guess what? That referral's not there because that borrower already went online and found a loan officer. More importantly, they found a mortgage and a loan officer was assigned to them. More and more consumers are going to the internet, they're filling out a form, they're getting an inquiry against the potential loan programs that they're qualified for. And what's actually happening is that's creating a lead. And you know this inside your own organization. What happens to that lead? It's assigned to a loan officer, and then the relationship is built, right? So get over this kind of concept, and I know there's people that are successful with this, but it's a really shrinking minority who can build a business off of that traditional retail model. You have to be moving into consumer direct because consumers are looking for a mortgage, they're looking for a loan program, and then they're assigned a loan officer. Now, just like real estate in that market, if you're watching that market too, real estate and mortgages are very similar. You need a real estate agent, you need a loan officer. There's no question that that role is very important as an advisor. But the way that role, that relationship is built has changed, right? Consumer goes to the web fills out a form, that lead is assigned to a loan officer, then a relationship's built. Make sure that you're embracing that model, not leaving it during this transition. And then finally, and probably the most complex of the four strategies that Rocket mentions inside the earnings call is sort of this concept of partnering with companies that offer some strategic advantages. Well, let me rephrase that. Partnering with companies where you can offer the strategic advantage of what you built in the previous three strategies, right? So theoretically, you've built a platform, right? A consumer direct platform. You've built some efficiencies in lending. Look for those you can come alongside. You can offer that platform, however small that is, right? It's getting easier and easier to build that platform. Obviously, Rocket Mortgage has spent millions of dollars to build their platform, but we at Kaleidico actually deliver a very similar platform on obviously a bit of a smaller scale, but some of the biggest lenders and names out there have used this platform, even some that compete directly with Rocket Mortgage. And guess what? That platform is free inside of our lead generation program. So this is not a pitch for that platform, but what it is to say it's very accessible. So, but the strategy here is to take a platform like that, to take your consumer direct platform and go alongside those people that need that efficiency, that consumer direct platform, and simply do it on their behalf, right? So what Rocket's done is they've gone out to banks, investment companies, Credit Karma, and they are the lender alongside of those, American Express, so those bigger brands. But you can do the same thing on a slightly different scale. So one of the places you should definitely go, instead of maybe investing all your time building relationships with realtors, actually invest some time in building relationships with regional banks, credit unions. All of them need mortgage assets and home equity assets on their balance sheet, but they're really inefficient at originating. You guys are the experts at originating. You potentially have the platform. Get together, do a deal, right? You get some nice stable funding, a good cost of funds as well, and you could potentially build a relationship just like Quicken Loans has done at a different scale, right? So they just partnered up with a new bank. That bank essentially got out of mortgage lending and said, hey, Quicken Loans, hey, Rocket Mortgage, you do this for us. You be the platform underneath us. So that is a strategy. The solar strategy is a similar one. Go out to home improvement companies, kitchen designers, bathroom designers, these people that are doing high-end renovations and remodeling, go to deck builders, go to cabinetry folks. Again, high-end home improvement, high-end home enhancement like solar, and see if you can do a deal with them. Hey, we can provide you home equity lending. And again, you're looking for businesses where homeowners often use the equity in their home equity loans, home equity lines of credit to finance these type of purchases. Team up with the business. Again, nice stable flow of referrals, high quality referrals. And again, you can come alongside, tightly integrate with them and be that strategic lending platform. So hopefully that gives you 4 strategies you can walk away with today. And it does 2 things for you. One, there's 4 strategies that you can try to implement. They're relatively simple, things that you can actually start doing today, right? And then the other thing is just by looking at a leader who's been through this before in some depth, spending a little bit of time understanding how they're doing it, might give you just a little bit of confidence that, hey, one, there's a timetable, right? This is probably only another 4 to 5 months. So it gives us a time horizon on this. And here are some strategies that are a little bit counter to the sort of big headlines that are popping through National Mortgage News and on CNBC, the doom and gloom kind of headlines. So anyway, take a look at these 4 strategies. If you have any feedback, I'd love to hear it. Reach out to me, and I'll continue to do these strategic memos as we kind of move through this transition. So hope you enjoyed this, got a little bit out of this, and it gives you some confidence that, hey, we're in this. There's an opportunity to gain market share. It's not a survival sort of thing. And again, you're going to pull through stronger in the next 3, 4, 5, 6 months. And on the other side of this, there's going to be tons and tons of lending. Market will come back to a more normal position. So good luck out there, and we'll see you next time.